might have seen the headlines recently. Commercial property prices down, what, a staggering 70%?
Yeah, it's quite something.
And iconic brands like McDonald's selling off their assets. And some people are even describing popular shopping districts as ghost towns. Hong Kong, a city long synonymous with bustling finance and, relentless ambition, seems to be navigating through a significant storm right now.
It definitely feels that way.
But beneath these turbulent waters lies this incredibly robust and intricate system. It's been the bedrock of its success for so long. Hong Kong's private financial license framework.
Right.
Today, we're going to unpack this because its resilience is truly being tested, and understanding it is, I think, key to understanding Hong Kong's future.
It's truly remarkable, isn't it, how this meticulously designed system, built for stability, for openness, is confronting these unprecedented challenges.
Exactly.
We'll explore how it works, what makes it unique, and its evolving role in a changing Hong Kong. Our mission really is to give you a comprehensive understanding, quickly and thoroughly, of both its current struggles and, its enduring strengths.
And we've got a stack of fascinating research for this deep dive, from the real nitty-gritty of regulatory documents to some eye-opening market commentary and recent news reports.
Good stuff.
It's sort of a shortcut, hopefully, to being well-informed about what is still a truly dynamic financial hub. So let's dive in. Okay, let's unpack this current situation then. Recent reports paint a pretty stark picture, don't they? Unemployment figures, especially for young people, they're climbing significantly.
They are.
We're looking at an overall unemployment rate of 3.5% as of, June 2024, which is the highest since December 2022.
Right, and for young people, it's even higher.
Yeah, much starker, hitting 6.8%.
And the broader economic situation beneath these numbers is, equally concerning. We see high jobless rates concentrated in sectors like construction, retail, accommodation, and food and beverage.
The F&B sector, yeah.
All hovering around 4.2%. And the impact is, you can see it's transforming Hong Kong's streets. Hundreds of shops, including many F&B places, closing or planning to close.
It's visible.
We're talking about decades-old brands, like Red Star Group, Union Palace, just disappearing, leaving empty storefronts behind.
Such familiar names, too. And the implications of these economic shifts become even more profound when we look at the actions of the major players.
Definitely.
It's not just the small businesses feeling the pinch, is it? When giants like McDonald's and even the legendary Li Ka-shing start making significant moves,
it signals something deeper.
Exactly, something deeper about market confidence. McDonald's, for instance, planning to sell a substantial portion of its Hong Kong properties, like 23 assets, worth billions of Hong Kong dollars.
Yeah, and that's a move you rarely see globally, outside of, major economic downturns or maybe post-war scenarios.
Yeah.
Japan in the 90s, Russia more recently.
Right, and Li Ka-shing.
Indeed, and the actions of Li Ka-shing's group are perhaps even more telling, particularly for the property market. His family is rumored to be selling their Deepwater Bay mansion below market value.
Wow.
And his conglomerate, Chung Hong, is reportedly offloading hundreds of properties, both in the Greater Bay Area and a Beijing luxury project, at really steep discounts, 50% in the GBA, 30% in Beijing.
That's significant discounting.
It is. And what's particularly insightful here, I think, is that his group's mainland asset proportion has just plummeted, from a peak of 75% down to less than 5%.
75 to under 5. Where's the capital going?
It's being strategically reallocated towards the UK, Europe, Southeast Asia, investing in everything from gas and power to telecom, logistics, even biotech.
Diversifying away.
There's a very clear investment strategy that, some observers characterize it as a vote for anywhere but mainland China.
Right.
He's even reported to have said, kind of wistfully perhaps, Hong Kong is truly yours now. Carries a profound sense of sentiment, doesn't it?
It really does. And these economic tremors, they aren't happening in a vacuum, are they? They're often viewed through the lens of political and social changes.
That's unavoidable.
Reports suggest external uncertainties and local policies are playing a significant role in how investors, how businesses perceive Hong Kong, even sparking debates about the city's autonomy.
You're right to connect those dots.
Right.
The implementation of the National Security Law and Article 23, it has been cited in some reports as directly impacting the city's perceived autonomy.
And investor confidence follows.
And consequently, investor confidence. Between 2020 and 2024, there's been a reported 15% job loss in the financial sector.
15%.
And some Asia-Pacific headquarters have reportedly moved maybe to Singapore or Tokyo.
We've heard those stories.
Furthermore, the U.S. termination of special trade status for Hong Kong back in 2020, that's seen by some as potentially undermining Hong Kong's long-term international advantages.
Especially if it leads to further alignment with mainland China's trade restrictions.
Exactly. That's the concern raised in some quarters.
And it's not just about economics or geopolitics, is it? There are also these growing concerns around, well, social freedoms.
Right.
The decline in press freedom, for instance, is striking. Hong Kong's ranking projected to drop dramatically, putting it in a category associated with very restrictive regimes near China and North Korea, according to some reports.
Yeah, those rankings are quite stark. And there are also reports of this pervading white terror atmosphere and limitations on basic freedom of expression.
That kind of atmosphere must have an effect.
These shifts certainly weigh on the social fabric. Public opinion surveys, I think from June 2025, indicated that nearly 67% of respondents believe there are fewer upward mobility opportunities for young people now compared to 10 years ago.
67%. That's a majority feeling pessimistic about the future for the youth.
Yeah. So this combination, the economic downturn, the shifts in political autonomy, these concerns over social freedoms, it's creating a very complex environment for Hong Kong.
Which makes the resilience of its financial system all the more critical to examine, right?
Absolutely.
So after that pretty stark look at the economic landscape, it might seem surprising that many still see Hong Kong as this incredibly robust financial center. How does it maintain that perception, especially when its overall economy is facing such strong headwinds?
That's precisely the fascinating paradox here, isn't it? The enduring strength lies in Hong Kong's meticulously structured financial system. It really rests on four interconnected pillars that have historically driven its openness and reliability, even when external pressures mount.
Okay, 4 pillars. What's the first one?
First, the constitutional guarantee. This comes from the Basic Law. It ensures a high degree of autonomy for Hong Kong, especially in independent monetary and financial affairs, and crucially, maintaining its capitalist system.
Right, the one country, two systems framework underpinning it.
Exactly. This isn't just some legal clause. It's the bedrock that underpins confidence in its distinct economic future.
And that autonomy, I guess, ties into the second pillar, which is Hong Kong's long-held economic philosophy, this positive non-interventionism.
That's exactly right. This philosophy translates into fostering free market competition and maintaining an incredibly simple and low-tax regime, which is a huge draw.
Simple and low tax. Tell me more.
For instance, there's a two-tier profits tax. So it means even lower rates for smaller profits, 8.25% on the first HK $2 million.
Okay.
And crucially, no capital gains tax, no VAT or GST, no dividend or interest withholding tax. Plus, it operates on a territorial source principle.
Meaning you only pay tax on profits actually made in Hong Kong.
Precisely. Only taxed on profits sourced in Hong Kong. This simplicity is a major draw for international businesses. It enables a free flow of capital and information, all characterized by what we sometimes call high trust, strict scrutiny.
High trust, strict scrutiny. I like that. It captures both the freedom and the rigor. What about the legal backbone that supports all this?
That's the third pillar, the common law system, inherited from the British system. It provides predictability, it respects contracts, protects property rights, and aligns Hong Kong with major international financial centers like London or New York.
So that international alignment is key for confidence.
It's absolutely critical. It's this legal certainty that gives international businesses confidence, knowing their contracts and property rights are upheld independently.
Okay, and the fourth pillar?
Finally, there's Hong Kong's strategic positioning. It's often called a super connector, and now maybe evolving into a super enhancer.
Super enhancer. What does that mean?
Well, it's always been the vital bridge between mainland China and international markets, right? It became the largest offshore RMB hub. But now it's evolving to offer even more complex, higher value services.
Like what?
Things like sophisticated asset management, wealth succession planning, cutting-edge green finance initiatives. It's about offering something genuinely unique, the most sophisticated yet accessible gateway to the massive Chinese market.
Right, the China access.
While also serving as a hub for these next-gen financial services.
Okay, so those 4 pillars, basic law guarantee, positive non-interventionism, common law, and strategic positioning, they sound like a really powerful blueprint. But how are they actually brought to life? Who are the day-to-day architects and enforcers? Who manages these licenses?
Exactly. That's where the regulators come in. These foundational principles are then implemented and enforced by 3 main independent regulatory bodies, each with very clear responsibilities.
Okay, who are there?
First, you have the Hong Kong Monetary Authority, or HKMA. They supervise the banks, ensure monetary stability, think the HK dollar peg, and they issue stored value facility licenses, SVFs, for things like e-wallets.
Octopus Card, Alipay, HK, that sort of thing.
Exactly. Their regulation is institution-based. Think of it as supervising the overall health and stability of an entire bank or financial institution.
Okay, so they focus on the stability of the institutions themselves. What about the capital markets? Stocks, bonds, funds?
That primarily falls to the Securities and Futures Commission, or SFC. They regulate the capital markets, securities, futures, asset management. But, and this is a key difference, with an activity-based approach.
Activity-based. How does that differ from the HKMA's institution-based?
It means if you're doing a certain activity, say dealing in securities, whether you're a big bank or a small independent firm, the SFC regulates that specific activity.
Ah, I see. So everyone doing the same thing plays by the same SFC rules for that activity.
Precisely. Ensures everyone playing in the capital markets adheres to the same rules for that particular business. They license for 10 of the 13 regulated activities under the ordinance.
Okay, and the third regulator?
And then the Insurance Authority, or IA. As the name suggests, they handle the regulation and authorization of insurance companies and insurance intermediaries, like brokers and agents.
Makes sense. Any others involved?
It's also worth a quick mention that the company's registry handles moneylenders, and the HK police often assist with enforcement for moneylenders too.
So it's a very specialized, multi-layered approach, trying to cover all the bases.
Absolutely. And an important distinction, particularly with the SFC and HKMA overlap, is between licensed corporations. These are non-bank entities directly licensed by the SFC.
Like a brokerage or an asset manager.
Exactly. And registered institutions. These are the banks approved by the HKMA that also register with the SFC to conduct securities-related activities.
Ah, so the bank itself is HKMA regulated, but its securities desk activity is SFC registered.
You got it. This structure ensures the principle of same business, same risk, same rules. It's vital for maintaining a level playing field and overall market integrity.
That makes perfect sense. Let's zoom in then on some of the most sought-after licenses, especially those crucial for private wealth management. What do the SFC's core licenses actually empower firms to do?
Okay. For private wealth, the SFC Type 9 license for asset management is absolutely critical. This allows firms to manage client portfolios, manage funds.
The core of wealth management.
The core. Then you often see SFC Type 1 for securities trading. That covers the actual buying and selling of stocks, bonds, derivatives for clients.
Execution.
Right. And SFC Type 4 for advising on securities. This means providing investment advice, perhaps producing research reports.
So Type 9 manage, Type 1 trade, Type 4 advise. Got it. And I remember reading about something called an incidental exemption. How does that work in practice? Seems quite important.
It is important. The incidental exemption is a key feature that genuinely makes the system more efficient, I think. If you hold a core license, let's say Type 9 for asset management,
Okay.
you may not need separate licenses for ancillary activities that are entirely subordinate or, well, incidental to that core business.
Like trading or advising related to the funds you manage.
Exactly. Like Type 1 for trading or Type 4 for advising if you're doing so purely in the course of managing those client funds under your Type 9 license.
So if I'm understanding correctly, this incidental exemption isn't just about cutting red tape, is it? It seems to really encourage specialization, allowing firms to focus on their core offering without getting bogged down in every single minute ancillary activity license. Is that the idea?
That's exactly the intention. It streamlines operations, reduces unnecessary compliance burdens, and encourages firms to focus on their core strengths. Makes the whole system more practical.
Makes sense. And what about family offices? Do they need these licenses?
That's a common question. It's also worth noting that many single-family offices often don't need an SFC license if they're serving only that single family, usually on a cost recovery basis, and not holding themselves out to the public.
But if they manage money for other families or engage in other regulated activities?
Then yes, they definitely require one. Or if they start offering services to third parties, the moment they cross that line, the licensing requirements kick in.
Okay. This balance of openness and efficiency sounds appealing. But going back to that strict scrutiny idea, how does Hong Kong ensure that only legitimate, robust players can operate? What's this gauntlet firms have to run to actually get licensed?
Ah, yes, the gauntlet. The rigor of the application process is where the strict scrutiny truly comes into play. The absolute core requirement, the heart of it all, is the fit and proper criterion.
Fit and proper. Sounds fundamental.
It is. And this isn't just a checkbox exercise. It's a deep dive into the financial soundness, the academic and professional qualifications, the industry experience, the integrity, reputation, and even the criminal record.
For the company.
For both the applicant company and all its key personnel, major shareholders, directors, senior management, everyone involved.
So it's not just about the company's balance sheet, but the actual individuals behind it. That sounds like serious due diligence.
It absolutely is. I've seen firms spend months, literally months, just getting their proposed responsible officers approved by the SFC. It's a real testament to how seriously they take these individual qualifications. It's about entrusting critical oversight to experienced, trustworthy hands.
So that's the people. What about the company structure itself?
The company also needs to demonstrate substance. This means it can't just be a shell company, a brass plate on a door.
Right. Needs to be real.
You must have a real registered Hong Kong company, a physical office located in Hong Kong, and demonstrate robust business structures with proper internal controls and compliance procedures mapped out.
And you mentioned responsible officers, ROs.
Yes, the responsible officers, or ROs. These are really the linchpin of SFC regulation for licensed corporations.
The key individuals.
Absolutely. You generally need at least 2 ROs for each regulated activity the firm wants to conduct. One of them must be an executive director of the company involved in supervising the business directly.
And based in Hong Kong.
And at least 1 RO overall must be resident in Hong Kong. They have very strict qualification requirements, relevant industry experience, specific management experience, and crucially, they carry personal accountability for supervising the regulated activities.
Personal accountability. That sounds like a very strong deterrent against misconduct or negligence.
It's intended to be. It really focuses the mind. And financially, what are the capital requirements? Are they high?
Good question. Finally, there are strict capital and financial soundness requirements. Firms need to demonstrate significant capital buffers.
How much are we talking?
Well, the requirements are tiered. They vary based on the license type and, importantly, whether the firm intends to hold client assets or not.
Holding client money means higher requirements.
Exactly. For example, a Type 9 asset management firm might only need HK $100,000 in liquid capital if it doesn't hold client assets. But if it does hold client assets, then it needs significantly more, typically HK $3 million in liquid capital and HK $5 million in paid-up share capital. Okay, so that ensures only robust, well-funded players enter the market, especially if they're handling client money.
That's the goal. The entire process, while definitely rigorous, is ultimately transparent. There are clear application fees, annual compliance costs like SFC annual fees, and audit fees.
And how long does it all take?
Approval times can vary quite a bit. Maybe 3-4 months for a simpler money lender license, but potentially 6-12 months for an SFC license involving multiple activities, and even 9-18 months for something complex like a private banking license application. It takes time.
So, with this sophisticated yet clearly rigorous system, how does Hong Kong really stack up against its global rivals? What makes it distinct from, say, Singapore or London?
That's a critical question, isn't it? Hong Kong's strategic play isn't really about being a direct replica of anywhere else. It's about leveraging its distinct advantages.
Okay, like compared to Singapore, they're often seen as the main competitor.
Right. If we compare it to Singapore, for instance, Hong Kong's simplicity strategy, particularly on the structural and tax side, shines through. For example, there's no mandatory local resident director requirement for a Hong Kong company, unlike Singapore.
That simplifies setup.
It does. And its tax structure is simpler. That lack of GST or VAT is a big difference compared to Singapore's 9% rate. And maybe most importantly, Hong Kong offers that unique China gateway role.
The access point.
Unmatched access to mainland high net worth clients through mechanisms like Stock Connect, Bond Connect, and the Wealth Management Connect scheme. That's an advantage Singapore just cannot replicate to the same extent.
Okay, that makes sense. And against a long-standing financial titan like London.
Versus London, Hong Kong often boasts stronger stock market liquidity, especially in recent years, and it remains a leading global center for IPOs, particularly for mainland Chinese companies seeking international capital.
Right, the pipeline from China.
Exactly. It also generally has higher insurance penetration than the UK market.
Yeah.
And again, that simpler, lower tax environment in Hong Kong provides a significant potential cost advantage compared to the UK's more complex system. So it's really about playing to its strengths in specific niches.
Especially its proximity and connections to mainland China.
That remains its irreplaceable, unique selling proposition, yes.
Even with these unique advantages, the financial world is constantly shifting, isn't it? How is Hong Kong adapting its licensing framework for the future, especially with emerging tech like fintech and new market demands?
Yeah, that's crucial. Expanding on that point, Hong Kong's regulatory framework is actively trying to lean into the future. It understands that it needs to evolve constantly to stay competitive.
So what are they doing specifically?
Well, they've established pretty clear licensing paths for fintech and virtual assets. We've seen licenses for virtual banks, virtual insurance companies, and importantly, virtual asset trading platforms, or VATPs.
The crypto exchanges.
Right. And there are upcoming regulations planned for stablecoins, too. Plus, initiatives like the Faster Payment System, FPS, and the Commercial Data Interchange are actively fostering innovation, making it easier for private tech firms to integrate and offer new services.
So it's not just about traditional finance, it's definitely embracing digital.
Exactly. They're also making a strong push into green and sustainable finance. There's a stated aim to be Asia's green finance hub
How?
by actively promoting things like green bonds and creating frameworks to support ESG environmental, social, governance investment opportunities, trying to capture that growing global market.
And what about the connection to mainland China? Is that evolving too?
Critically, yes, there's the ongoing deepening of Greater Bay Area or GBA integration, particularly through mechanisms like the Cross-Boundary Wealth Management Connect scheme.
How does that change things?
Well, it effectively expands the potential addressable market for Hong Kong licensed financial institutions from Hong Kong's population of around 7 million to over 80 million people across the whole Greater Bay Area region in southern China.
That's a huge potential client base expansion.
It's massive.
Yeah.
So this integration with the mainland, while sometimes viewed through a political lens, is fundamentally about market expansion and opportunity for Hong Kong's financial institutions.
Of course, it's not all smooth sailing.
No, absolutely not. Hong Kong acknowledges ongoing challenges, constant global regulatory changes they need to adapt to, geopolitical factors that create uncertainty, and of course, persistent competition from other financial centers like Singapore, Tokyo, London, New York. But the adaptability built into its licensing framework is really a core part of its strategy to try and remain competitive through all this.
So we've journeyed through this really dynamic landscape of Hong Kong's financial world today. From those immediate economic headwinds and the, frankly, dramatic exits of some major players.
Yeah, quite stark.
To the intricate design of its private financial license system, built on those foundational pillars we discussed and that rigorous oversight. It's clear we're looking at a city in transition, yet one with these deeply embedded strengths, particularly in its financial framework.
This then leads us back to ask, doesn't it?
Yeah.
How long can this meticulously crafted financial framework continue to super enhance, as we called it, when other foundational pillars like certain aspects of market confidence or the broader legal and social environment are arguably being tested?
That's a core question.
It truly is a testament, though, to the system's inherent resilience and its adaptability that it continues to evolve and remain relevant, even amidst such profound external shifts and pressures.
Indeed. As Hong Kong navigates these really complex shifts, it leaves us, and maybe you listening, with this to ponder. Can a financial engine built on such solid regulatory and legal principles truly thrive indefinitely, even as the socio-political ground beneath it continues to shift and perhaps redefine itself?